Financial Statement Analysis for AGL Energy Limited by Daniel Smith, Hugh Fleming, Adrian Grant, Hrithik Kumar and Danielle DeBull.
Economic decisions are conducted by a company on the basis of financial statement analysis that allow individuals to assess the position of the company in the industry for personal benefit. This assignment adjusts the financial standings of AGL Energy Limited by first undertaking the strategy analysis of AGL. Then, the financial analysis is conducted where it evaluates the operating, investment and financial management before prospective analysis on the forecasting and valuation of AGL is conducted. Finally, credit analysis allows individuals to measure the financial distress through Altman Z-score model to conclude AGL's analysis of their financial performance. Hi, I'm Hugh Fleming and I will be talking to you about strategy analysis. In strategy analysis, there are reported as 5 forces. Force 1 is a rivalry among existing firms. AGL Energy operates in a highly competitive industry, competing on price instead of product differentiation. The rivalry is high due to low switching cost, which makes it easier for other firms to attract consumers. The second force is the threat of new entrants. Threat of new entrants are relatively low as there are legal barriers, pre-existing distributions, and economies of scale. Force 3 is the threat of substitute products. At present, the threat of substitute or alternative products is low, as nuclear energy is the biggest threat. However, none of AGL's competitors can legally utilise the advantages of nuclear energy. The fourth force is bargaining power of buyers. There is a relatively moderate bargaining power of buyers due to the non-existing switching costs. The fifth force is bargaining power of suppliers. Bargaining power of suppliers is relatively low as there are many industries competing, offering the best prices to attract the consumers. It is imperative for a firm to assess and understand their competitive strategy in the industry. One strategy firms adopt is product differentiation. This is the business strategy which aims to create a competitive advantage through company producing a unique and distinct product from competitors. This allows for much greater profit margin. Product differentiation is not heavily present in the energy market as they are mostly providing the same good. Another strategy is the cost leadership strategy. This is a business strategy which aims to create a competitive advantage through a company projecting itself as the cheapest manufacturer of a particular product in competition. The advantage is that it is highly effective at drawing consumers' attention, which consequently can allow for economies of scale to manifest. In the case of AGL, cost leadership is the key model used for competitive advantage in the energy market due to the same products being sold in the industry.
Hi, I'm Danielle and I'll be discussing the financial analysis for AGL Energy. Starting off with the profitability analysis. This was assessed through return of equity and return on asset ratios. In the case of AGL Energy, their return on equity throughout 2017 to 2020 was recorded positive, which is a significant improvement from the negative percentage in the base year of 2016, and shows great improvement in performance and satisfactory management of income through equity. As for their return of asset, they recorded similar results as their return of equity. This suggests that they have been able to improve their profitability despite variance each year. For the operating management and valuation, AGL Energy has an increase in their gross profit margin from 27% in 2016 to 29% in 2020. This indicates that the company has been able to improve their ability to make profits on sales while also controlling overhead costs. We see an increase in both EBIT and EBITDA, which indicates that the company has been able to increase its sales whilst also reducing their cost of production. For investment management and valuation, this was evaluated through working capital management. From 2016 to 2019, we generally see a decrease in net working capital, which indicates troubled cash inflows and outflows. As for their accounts receivable turnover, AGL Energy recorded at low figures from 7.5 to 7.7, which indicates a poor debt collection process. As for AGL's financial management evaluation, their current ratio shows a consistent trend where they have a good ability to pay short-term obligations. However, they have an extremely low net debit to capital ratio of 0.2, which suggests that AGL is not investable. For the common size income statement and balance sheet, AGL has a strong balance sheet and income statement and has performed consistently over the past 5 years, becoming the more profitable and giving back to its stakeholders.
Hi there, I'm Daniel and I'll be talking about the forecasting data for our group's prospective analysis of the AGL. So what we've done is we've used the past 5 years of financial data, so the 2016 to 2020 periods, and from there what we've done is we've used the relevant ratios and applied them to the financial statements to forecast the next 10 years of data until the terminal year of 2031. So we've used the ratios which include the sales growth rate, the NOPAT margin, the beginning net working capital to sales ratio, as long as the net long-term assets to sales ratio, along with the debt to capital ratio, the after-tax cost of debt, and the dividend rate. Okay, and then what we've done from there, just to ensure that that's all correct, is we've used Morningstar's data analysis premium to verify our calculations and make sure everything's above board. From here, what we've done is, as I said, we apply all of those ratios and formulas to the financial statements, and what the results have showed is that AGL is in a strong financial position. They have consistent earnings and profit margins. The data also shows that the net working capital is positive and will continue to stay positive until the terminal year. Net debt also does increase, but the NOPAT margin growth actually exceeds this rate of debt growth, so that's not too much of a concern. In terms of dividend distributions, we see these being maintained for the next 10 years, and we don't see any reason for dividends to sort of be ceased and not be paid out to shareholders. In terms of the debt factors, the firm is in a strong position and bankruptcy does not seem likely, but again, this will be covered in more detail in the credit analysis using the Altman Z-score. But overall, the forecasting does sort of say that in terms of operations, there's no sort of major urgencies that requires any sort of change, because everything does look sort of positive, and that AGL is in a strong financial position, and shareholders shouldn't be too concerned.
Thanks, Daniel. Hi, I'm Horrific, and I'll be going through the valuation figures of AGL Energy's prospective analysis. Valuation refers to the process of converting a forecast into an estimation of a firm's value. Now, throughout the valuation process, we've used the 10-year forecasted figures from earlier to establish various models and approaches to valuation. The first of these models is the discounted dividends valuation, and it's a quantitative method that determines the present equity value of future cash flows to its shareholders. To account for the time value of money, we discount the dividends from the 2021 to 2030 period to present terms and used a cost of equity capital of 4.5%. By doing this, we calculate the equity value of AGL to be $4.8 billion. This indicates that the company won't face any financial distress or major losses, and from that, we establish the fact that AGL will continue to pay dividends to its shareholders, which ultimately benefits all parties involved. Moving on to the discounted abnormal earnings. This method is used to evaluate the firm's equity based on its book value of equity and present value of future abnormal earnings. Over the forecasted period, the net income and normal earnings figures grow each year, which also invites the abnormal earnings to increase. Again, using a cost of equity capital of 4.5%, we determine AGL's equity value to be $110.7 billion. This means that the firm's market share price is considered fairly valued, and the positive abnormal earnings figures in the long-term perspective provide an opportunity to sell at a premium to the book value. Finally, the discounted cash flow model determines the equity value of a firm by calculating the present value of free cash flows to equity claim holders in the future. The cash flows used in this model were positive, and therefore general trends of an upward nature were observed, indicating possible firm growth. The equity value is calculated to be $112.8 billion, and similar to the previous model, this indicates that the firm's shares are fairly valued with an opportunity to grow. By combining these three approaches, we conclude that the prospects of AGL's future seem positive, with a potential to grow within the utilities market. This company will continue to distribute dividends to its shareholders and have sufficient equity capital, so there's no red flags there. Since the majority of figures that were produced were positive, AGL is fairly valued and can be considered a good investment for relevant investors. AGL shows no concerns regarding its equity value for the future and appears to be in good financial health.
This is Adrian, and I'll be covering credit analysis for AGL Energy. So credit analysis allows us to measure the ability of a business to honor their financial obligations to investors and pay their debts. Credit analysis uses the Altman model by analyzing the Z-score to determine AGL Energy Limited's likelihood of bankruptcy. Now, Altman's Z-score model uses figures of working capital, retained earnings, earnings for interest and tax, market value of equity, and sales to construct an equation that will show the likelihood of the business going bankrupt. A Z-score below 1.81 is considered at risk of bankruptcy. A score over 2.67 is low risk, and between the two is considered the grey area. The Z-score for AGL Energy Limited in 2016 was 2.304 and grew to 3.188 in 2018. This is an extremely healthy score to achieve as it falls in the low risk of bankruptcy area. However, over the next 2 years, AGL Energy's Z-score dropped substantially from 3.188 in 2018 to 2.442 in 2020. A contributing factor shows a decrease from 2.471 billion in 2018 to 1.632 billion in 2020. Finally, with a relatively average Z-score of 2.44 in 2020, AGL Energy Limited seems to be in little threat of bankruptcy. However, because the score is within the range of 1.81 and 2.67, it is unsure whether bankruptcy is completely out of the picture. To conclude, strategy, financial perspective, and credit analysis, which we previously discussed, are all critical components in determining the current level of performance of an industry, and they collectively allow us to estimate the future performance of the firm. They can also assess how effectively the firm is managing its day-to-day operations and whether any adjustments should be made in the firm's execution of its operations. For AGL Energy Limited, consideration of all these aspects has provided a clear indication that they're carrying out their services at a satisfactory to high level of performance. And this is in large part due to their high level of efficiency at utilizing assets to generate revenue and maintain its profits. Despite this, AGL Energy should aim to further take advantage of their strength by continuing to finance greater quantities of assets or perhaps look to invest more using their large portion of residual capital. Additionally, AGL Energy usually has a relatively low amount of debt in the form of borrowings to pay, which is another promising sign that indicates they will not be bankrupt or have to resort to liquidation of their assets. Therefore, AGL Energy should be content with their current circumstances and be optimistic about their future.